Thanks, Dan, and thanks, Matt, for joining me on what is our final edition of Wealth Wednesday for this season, anyway.
Thanks for having me. Happy to be here.
Great. Throughout this season of Wealth Wednesday and even beyond that, inflation and interest rates the rising inflation and interest rates have been a huge thing for people. Kind of give a breakdown about what those things are and how they connect to each other.
Yeah, we have a hot topic. So, okay, there's more to it than this. I'm going to keep this kind of high level and basic. So like you said, many people realize that a lot of things have noticeably became more expensive than they were before. What this is inflation, and the cause of this is a result of an imbalance of supply and demand. High supply, low demand. Okay, so through 2020 and 2021, many people actually spent less and saved more. And demand for goods and services started to build up. Meanwhile, supply of the things that people wanted was constrained due to things such as lower workforce, higher transportation costs, geopolitical factors such as different countries' policies and COVID, just to name a few. In an attempt to correct this imbalance, the government and central banks have minimal things they can do to fix the supply issue, but what they can do is impact demand. And they do this by increasing interest rates. What this is supposed to do is lower demand by basically giving people less disposable income. For example, if a person pays more interest on their mortgage every year, they might think twice about going out and paying a little bit extra for a product or service they want but maybe don't necessarily need. And the idea is to bring the supply and demand back in line, thus lowering inflation.
So then, how do those two things then? How do they impact people's financial investments?
Yeah. So, at first the impact is generally negative. Which many people probably noticed when looking at their investment statements last year. But this is temporary. Good corporations are still and will continue to make profits and grow, though their growth might not be as fast or as rapid in previous years. But good quality stocks will make money over the long term. And now that interest rates are higher, fixed income investments such as bonds and GICs look reasonably attractive right now. Bonds did decline quite dramatically last year, which was actually a result from the rapid increase of interest rates. But they will, and they've already started to recover. And based on history, they should recover rather quickly. And this should happen when interest rates settle in at a point where supply and demand are a little bit more balanced and inflation has come down to where the central banks want it to be. So GIC rates, like I said, are pretty good right now. But unlike a bond, if you had locked in a GIC at a low rate, say a couple of years ago, you're just going to have to wait till that GIC matures to be able to reinvest it and take advantage of today's better rates. As always, it's very important to speak to a certified financial planner, a good advisor, review your financial plan, review your investments, make sure you're properly invested for your situation, review your goals, and make sure you're on track to meet those goals.
Great. Well, thanks very much for coming in again and sharing that advice and throughout the season.
Yeah, thanks so much. Take care.